Hey, everybody, welcome to today's webinar. We're going to get started here in just a second as you all get situated to today's virtual presentation brought to you by Altos. Hope everyone's having a great day. Happy Hump Day, Wednesday, August 20th. All right, let's get started. The numbers are climbing very rapidly. I assume it's not for me, it's for the man standing next to me. Welcome to this month's webinar. If you are new to Altos, we deliver real-time housing market data that helps agents like you answer the question, how's the market? Not only answer that question, but share with your clients, with your sphere of influence, exactly what's happening, positioning you as the expert. I am joined by the one, the only, our special guest, Mr. Logan Mohtashami. Welcome, Logan.
It is wonderful to be here, by the way, in our first Altos. And I'm probably going to bring a little bit more of a different vibe than Mike, but we're going to keep the data very simple and understandable for everyone. And like we've always said, we believe this is the best, fastest, freshest data line for everyone to use. And we'll explain that today for everyone.
Awesome. Well, Logan, for those that don't know, is the lead analyst for Housing Wire and a regular contributor to the Housing Wire Daily podcast. He helps decipher the complex world of economic data and translates it into actionable data that you can easily talk about. So his unique style and his amazing hairstyle have graced the TV airwaves with CNBC most recently yesterday morning. We are very lucky to have him. So many thanks to you, Logan, for joining us today. All right, as always, Altos is here to help you take the national housing narratives, many of which Logan is going to be speaking about, and translate them on a local level using our data. So Logan's going to help you with the narratives, and then our team hopefully is going to help you understand how you can take that insight and share it locally with everyone that you feel like could possibly be a future client, a past client, current client, whatever the case may be. Now, a couple housekeeping items before we get started this morning. First is that the chat function is open. I see many of you are using that functionality right now. Feel free to ask any question that you might have. If we have some extra time, we will ask Logan specifically some of the top questions that we're getting from the chat. But the most common question that we get is, how is my market doing? And unfortunately, like every monthly webinar, it's very hard to get to everyone's market. So what you can do is access your data in the Altos platform. So for those of you that are not currently in Altos, go to the website, click the link in the chat right now, get your free report. It takes about 2 minutes. By the time I'm done talking, you can be in your account. No credit card required, just 4 or 5 simple fields that you have to complete. Get your market data, have that going side by side as you're listening to what Logan is about to say. Next, I do want to remind you that Altos not only provides this local market data, but we help you distribute it to your sphere of influence. So if you'd like to learn more about how the platform automations can help you build new leads, communicate with previous clients, click the next link in the chat, schedule some time with our team, and they will be very glad to talk to you about how Altos can power your success as a housing professional. All right, with further ado, hopefully everyone is in the platform at this point. I am going to cease talking and pass to the master of data, Mr. Logan Mohtashami. Logan, please take it away.
It is wonderful to be here. Now, what I do every single day, for those who follow me, I talk about the national economy and the housing market. And what we do with Altos data is give everyone a taste of what the national data is doing. But if you want to be a more prolific realtor, real estate investor, mortgage loan officer, even Wall Street finds us, you need to get it in your own area, right? If you want to talk about national economics, that's fine. But our clients come to us because, we're fresh, we're live, we're weekly. And just to give you guys a good test case example, late 2022, right? In late 2022, everyone was so sure that home prices were about to crash and home sales were done and all this glorious doom porn, as I always say, was about to happen. And yet our forward-looking data starting November 9th, and those who have followed our work, started to get better. Right. And my job on the national side is to give you the big kind of macro takes, but you in your own area could have been a housing expert above most other people. And again, we're about 2-3 months ahead of everyone else, ahead of Case Shiller. We're ahead of the NAR, existing home sales board. We think current and forward looking data. We do not want to be stale. So what happened in 2023 took everyone 4, 5, 6 months to realize, what they were saying at the end of 2022 didn't occur. So my job is just to kind of explain this. But if you want to be an expert in your area, you have to get your own city, zip code, or wherever you want to farm out. There is no way we could address all 50 nations. And this is why we're going to give you the broad scope of how to look at data. And then you yourselves can talk about it in whatever form you want to do. Or what we're seeing right now, since the market is changing, a lot of listing agents like our data line so they could convince home sellers that, hey, listen, it isn't the market of 2020, 2021, or early 2022. And that way you can be more efficient at your job. And I think that's the thing about right now at this point of the cycle. It's a little bit different. When inventory is all-time lows and mortgage rates are at 3%, anybody could do anything. You could put a house on the market and not do any work. It'll sell. Now it's much different. And again, it's much different in each state as well. So we're going to talk about the active inventory data. And for those that follow our weekend tracker, what I saw is every single year there's some point of a reference that the tracker picks up. And mid-June, when mortgage rates started to creep down a little bit lower, what I saw in the tracker was a stabilization. Now, my self-bias is I love 2024 housing. I love 2025 housing because inventory is growing again, right? Not a mortgage rate lockdown person. Higher rates can create higher inventory because it takes longer to sell a house, right? There's going to be a difference between active inventory and new listings. But what's occurring in 2025 was super healthy, not only for the housing market this year, but for many years. However, starting in mid-June, things started to stabilize a little bit. And this is happening with mortgage rates above 6.64. And the reason I always use 6.64 to 6%, what I've seen in the housing data is when rates get below 6.64, heading towards 6%, the data line changes, right? The pricing curve changes, the inventory changes, the price cut percentage changes. What I saw mid-June was that was happening with elevated rates. So it piques my interest, but then everybody gets to see it. And you can see it in your own city or zip code if that's the case. Well, July the 4th comes again with all holiday weekends. There's always 2 weeks where our weekly data gets messed up. But after that, nothing really changed. But the last 2 weeks, something happened that has never happened in our own data lines. Active inventory fell. And the pickup that I was supposed to look for this week didn't really happen. This means that for the first time in many years, active inventory is starting to fall earlier, which comes back to a normal marketplace. The last few years, inventory was peaking out in October and November. Okay, that gives us an idea about going into next year. So one of the things we're thinking about now, if hypothetically mortgage rates go down even lower towards 6%, we're already seeing the inventory curve change. A good example is inventory was growing at 33% year over year. That is a very elevated and healthy level for us. However, recently that's already come down 10%. So if the demand picks up a little bit better and inventory starts to slow down, we're seeing a different inventory curve, much healthier. As you could see in the active listings data, we had only 240,000 homes available for sale in March of 2022. The housing market was very unhealthy late 2020, all of 2021, and early 2022. We deemed it savagely unhealthy. Much healthier market. And as you could see, national home prices aren't crashing. This isn't the market of 2008 to 2012. The inventory and credit channels are different. But right now, ahead of everyone else, we're already seeing a change. You can be that person in your own area, right? You can be that expert in your own city. You can be in your own state. However you want to do it, this data line gets you ahead of the NAR, gets you more prolific than census data, and you can learn it. And every time you adjust yourself and learn every single week, you become a better expert. But our next data line that I love is our new listings data. Now, I always tell people, how do I know a professional grifter from a real housing person, right? And a lot of it is the new listings data. We always say the Housing 2008 crowd, not the most talented group of people, but the new listings data back then, because the credit markets were different, these are homes that come onto the market that don't get a buyer right away. Back in 2008 to 2012, that area, we were running at 250 to 400,000 per week. Those were not sellers that were going to be buyers. Just to give you guys a great example, the legend Mike Simonson went to Lehman Brothers in 2007, told Lehman Brothers, hey, listen, we have a new way of tracking housing. It doesn't look good to us. Lehman Brothers said, no, I got 85 analysts. We know what we're doing. Mike says, okay, sees Goldman Sachs. Mike walks down 30 feet, talks to Goldman Sachs. Goldman Sachs takes the data, says, oh boy, shorts the housing market, makes $10 billion. Lehman goes out of business. We believe we are the most prolific data miners in housing. And you know me, I am not shy about it. I will debate any person on planet Earth 24/7. Give me your models versus mines. But here, new listings data the last 5 years have been the lowest levels ever recorded in history. The so-called Airbnb crash or the stock traders saying, oh my God, everyone's going to rush to sell their house never was in the data once. 2023, the lowest new listings data ever in history. In the second half of 2022, you would have picked that up. 2024 picked up a little bit still, the second lowest. Here, I was thinking we could get to 80,000, right? Seasonal peak in this data line is between 80 to 100,000 in the last decade, 2013 to 2019. So I was encouraged that we got to 80,000. That was my call last year. Didn't get it, short 5,000. But here, that 80,000 didn't have any legs. We get up to 80, we go down, it goes up to a little bit above 80,000, go down. The new listings data started to peak around May 23rd and then started to trend lower. Now in 2025, the new listings data is trending lower than 2022. This is not what I want to see because 70 to 80% of home sellers are buyers. You can do this in your own area, own zip code, own city, own state. There's 108,000 cities out there in America. You can't go every single one on any kind of page. But here, what I'm seeing is that sellers are not listing as much as they did. They're calling it a little bit quits. I was so surprised last week. I was expecting a year-over-year growth because 2 weeks ago, we had an off thing that happened last year. Didn't get it. Surprised again. So if this trend continues, right, we'll know this all the way to the end of the year, but you'll know this for your area as well. So I'm not encouraged that new listings data starting to climb, but as you can see, if there was ever a pack of sellers rushing to the market, we'll see it first. You'll see it first in your area. You can tell your clients, but it's not even happening. Not only that, it's starting to disappoint right now. Why? The credit markets are much different right now, right? Homeowners in America have never looked better. I always say that if you take the wealth of the United States of America, maybe Cleopatra, adjusting to inflation, had more wealth, but homeowners on paper look very good. If there's any stress in the systems, you'll see it first in the new listings in your area, right? What's happening in Florida is different than what's happening in South Dakota. What's happening in South Dakota is different than Arizona. What's happening in Arizona is different than New Jersey, right? There's just way too many cities out there that have different variables to work with them. But you can be an expert in your area. But the new listings data on the national side is starting to really disappoint me. That is not what I want to see. But again, it shows you that home sellers are in control of their own destiny. If something ever happens, this thing breaks. And the next chart. Okay, the price cut percentage, one of the most healthy things that I saw, as you can see in 2022, this market was so savagely unhealthy. I believe 87% of homes in America, the first 2 months of 2022 were having multiple bids. We're not talking 3, 4, 5. We're talking 15, 20, 35. That is not a healthy housing market, AKA part of team higher rates in February of 2021. We had to somehow break this. And oddly enough, 4 to 5% mortgage rates weren't going to do it, even though that was the high level of the last decade. It really did take, 6.5 to 7.5% mortgage rates. Slope of the curve economics. As you can see in 2022, the slope of the curve was very aggressive. 2022, I'm telling you, everyone, was the craziest housing year ever. Crazier than COVID, crazier than housing 2008. We went from 3% mortgage rates to a year that was running at 18% home price growth, to the biggest and fastest crash in home sales ever, from mortgage rates going from 3 to 7, from active inventory picking from the lowest levels ever, a very sharp slope curve. And then after November 9th, pretty much everything changed, right? Home sales stopped crashing. We've been pretty much flat for years, but the price cut percentage is increasing. Now, this is our highest price cut percentage we've seen in many, many years. Healthy in my regards, but in your area, it can be different. Again, it's going to be different in New Jersey than it is in Naples, Florida, than it is in Phoenix, Arizona. You need to be an expert in your own area out there so you can, if you're a real estate agent, you could be a more prolific real estate agent to tell your sellers, this is not the market of here. You do not want to waste time on a house listing for 3 or 4 months because the seller doesn't know. The more knowledge you have, the more trust you will get. We believe this baseline data, now it gets more prolific when you join Altos. It becomes much easier. My job is to give you the economics of it. And what we're seeing recently is that the price cut percentage is stabilizing. All this is happening with mortgage rates not at 6%. This is the surprise for me in 2025 that I've only seen the data change really from 6.64 to 6%. We're already seeing this. How could this be? Every year, wages grow. Every year, households forms. People get married, right? If price growth slows down, the affordability gets a little bit better that way. If rates then go down in that environment, you get a little bit more buying power in that regards. This is why it was very critical to get higher mortgage rates to slow the price growth down of the national market. But what we are discussing here right now is the national game. Now, national economics, what drives the economy, can drive mortgage rates, and that will be a big changer whenever that happens. But each single market is going to be a little bit different. And if you want to wait for the NAR report, if you want to be old and slow like the Federal Reserve, by all means. But if you want to be a prolific data miner, remember, 2,000 years ago, you couldn't do this, right? You had to get paper, horses, you got to have, it takes you 6 months to get news. You could get this in your fingertips. And the more knowledge you have, the more trust you will get. This is why Wall Street comes to us. This is why prolific real estate investors come to us. This is why prolific realtors come to us and loan officers, because they want to be knowledgeable on the current day. You don't want to wait to what happened in 2023. It took people 6 months to realize what was happening in the data that we were starting to pick up toward the end of 2022. So this is just a taste, and this is just the national marketplace. I can talk about the national marketplace. I can talk about the economy. I can talk about what drives mortgage rates, what the labor market is doing. But this is just a piece of the pie. Every single one of you that are watching this right now are probably more invested than other people. If you really want to be an expert in your area, you get yourself this data line and you learn from it every single week. And then you could be more prolific than 99.9% of the people out there, because what I see are a lot of people who are not trained, a lot of people who are not data scientists, who are not analysts, who have no working models and just throw stuff up in the air. If you want to be one of those people, by all means, there's a ton of them out there on YouTube, X, and everywhere else. But if you want to be serious, this Altos data is for you. If you do not want to be serious, then this is not the area for you. There are tons of what we call third-party regurgitators that take information from a third party, package it up, and send it out and go ahead. This is a little bit more detailed. If you just get a free zip code and let them do a demo, you can realize how much more knowledgeable you'll be. This is just a taste of the sweet tasting pie that we have here at Altos Research.
Yeah, thanks, Logan. And when we talk about analyzing the data, talking about the data, one thing that I do want to mention to everyone that's on the call today is that Altos just released a ebook that will help you really understand the data dictionary within the Altos system, how to talk about inventory, how to talk about the market action index, which is our proprietary system of identifying buyers or sellers market. So we're going to plug that in the chat right now so that you guys can go ahead and get that resource. I can't guarantee you it'll make you talk like Logan, but it will give you the information that you need to understand how to read the data and do exactly what he's talking about. Logan, a question from the chat that I'd love to surface to you. There have been lots of talks about a rate cut from the Fed, but we saw this week that rates already moved. Are they going to move further, or is this a pre-baked in movement? Is this the Fed being too slow and the market moving faster? Can you talk a little bit about that dynamic?
So let's all remember one thing. Mortgage rates went from 8% to 6.63% in 2023 through the early part of 2024, then went back up to 7.5%, then from 7.5% to 6%, no rate cuts. We had a 2% rate cut move, no rate cuts. What happened? The bond market typically gets ahead of the Fed. The 10-year yield, 30-year yield, I mean, shorter term bonds really run the show with Fed rate cuts. It's the economic data that drives the bond market. And the bond market sometimes could get really ahead of the Federal Reserve. And what happened last year is that at the very, very bottom of mortgage rates last year, the economic data started to stop getting worse and it got better. And some of you guys, if you follow the City Surprise Index, you would understand this. And then as the economic data started to get better and the Fed was cutting rates, the Fed's Fed fund rate was right here. The bond market was right here. So something has to happen, right? Either Fed has to cut here or bond market comes up. Bond market did what it's supposed to do. Economic data was getting better and bond yields went up. Where we are currently right now with the 10-year yield and mortgage rates, it looks right to me with core CPI running at 3.1% with the Fed funds rate. Remember, if you look back in the history of economics, what do we always say? The 10-year yield and 30-year mortgage rates has a lovely slow dance. And then it's the spreads, right? 65 to 75% of where the 10-year yield and 30-year mortgage rates can go is really Fed policy. Then you work off the mortgage spreads. Mortgage rates are near year-to-date lows today because the spreads are better, right? Last year, it took 3.63 on the 10-year yield to get near 6% rates. Now, because mortgage spreads are improving, in that case, you could get better rates this year than last year. But the bond market has already anticipated a move right now, but we are pretty much in middle of, guess what? Either the job data needs to get worse or the 10-year yield is really priced in everything it has for this year. So whatever happens with the rate cut, it's a little bit different now because the growth rate of inflation is picking up to the upside. So what Jerome Powell says on Jackson Hole, or whatever happens with the Fed, we had a lot of news with the Federal Reserve today and certain members, the economic data still runs the show. So the labor data dictates everything. But right now, a lot of things already got priced in before the Fed rate cut, in which always is the case right now. Even if they cut rates, you might not see any kind of movement where we are. If we were already lower, if we were like 380, 390 in the 10-year yield, I would say that's still way too low to where Fed policy is. You really need weaker economic data. So you follow the labor market. As Sarah and I always go, paper, rock, scissors, labor over inflation, right? The growth rate of inflation has already fallen a lot, but we never got sub 6% mortgage rates because Fed policy is here. So labor data runs everything. You need a lot more weaker data to warrant rates to really go lower and stay longer, or for the Fed to really want to start cutting 2 or 3 more times.
It's interesting. There's almost a paradox going on, right? The savagely unhealthy housing market is not great for long-term housing stability, but for agents that are on the call, they're probably looking back to those days and saying, if you get a listing, you are just, you don't have to do much, and I don't mean to minimize it, but there is a feeding frenzy going on over these houses. Now with inventory, higher levels, economic data a little bit weaker, your comment earlier is that we are in a more balanced market. But for agents on the call, maybe the perception is this is not a great market. Is that recency bias, or are you coming at this from the perspective of healthy is better, and we need to be in this healthy range so that we can continue long-term growth?
So one of the things I always like to show is long-term charts of inventory and what's happened over the last 10 years before 2020 even occurred. Inventory has been slowly moving lower. So my model, oddly enough, Mike Simonson and myself are not mortgage rate lockdown people, but for 2 completely different reasons. For me, after a qualified mortgage went in, 70 to 80% of home sellers are buyers. That 20 to 30% inventory that's left over, guess what? Guess who the biggest buyers were for a long time? Millennials. They don't give you a house. So inventory slowly went lower, 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 lower. And then 2020 came, inventory broke to all-time lows, 3% mortgage rates. That is not a healthy market. I know for everyone else, they could sell homes very easily. You put anything on the market, you got multiple bids. The sustainability of the housing market long-term that was not a good thing. So being part of team higher rates early 2021 was saying, hey, listen, we need rates to create some balance here or prices could escalate out of control. Now, of course, home prices grew faster from 1943 to 1947. They even grew faster from 1974 to 1979. But this just shortages, right? I'm not a low inventory person, but 2020 was different, right? We had too many multiple bids, too many people chasing too few homes. We had to get inventory back to normal. So it might not feel like a healthier housing market, but I love housing 2024. I love housing 2025 because you're not going to get 3% or 4% mortgage rates anytime soon. What you can have is price growth slowing down, wages rise, households form, rates go a little bit lower, you can get demand up. We had similar things that happened in the 1980s, right? The early 1980s, affordability was actually worse in the early 1980s. We had 2 recessions back then. Credit data was terrible compared to now. But eventually, when rates fell down, home sales rose. If you look at the history of housing economics going back decades, there's always periods of times where rates go up, demand falls, we find a bottom, we stabilize, and then rates fall, and then we have years of growth. But that needs to happen with price growth cooling down, households being formed, and wages grow, because we're not going to get 3 to 4% mortgage rates. We don't need that to grow sales, but we do need rates getting down towards 6%. That's a more realistic target with where Fed policy is and where the spreads are. If mortgage spreads go back to normal, we're sub 6% today. So you have some benefits to try to get down there, but that's the most realistic thing. This is why I love housing 2024 and 2025. And I'm not liking the new listings data where it's going right now, but doesn't matter what I want. It's what the marketplace tells me, and that's why the data line is here to give everybody heads up, because you don't want to wait until August and September and go, hey, listen, the inventory data changed. We started picking this up mid-June.
That's great. So let's talk about rates at duration. I think that there have been moments in time last year. I know that we had a rate decrease that sparked some movement towards the end of the year, but we didn't see the duration. What's the relationship between duration and identifying that, we're at 6% interest rates maybe for 6, 7 months and the impact that it has on the housing market versus just the blip? Is that something you can talk about?
So for those that have followed me, I create mythical fictional figures for certain levels with a 10-year yield. In 2023, there was a level at 3.37. I said, guys, I don't think we should go below this. We pretty much have to be in a recession. So I brought Gandalf the Gray, and we shall not pass this level. It got tested 8 times. Rates should be higher based on the economic data. So rates went up. Last year, did not think we should be below 380 until the labor market starts to break. We were there for just a little bit. Rates went up. Fed policy is still restrictive for housing. If you get more rate cuts, the band goes a little bit lower. You could get to 6% and stay there lower. But to me, duration is a labor story. If the labor market starts to break, if you look at the history of housing and economic cycles, housing tends to outperform during a recession because rates go lower. And we show those charts with our existing home sales. You typically see the bottom and sales go up Now imagine, hypothetically, let's say mortgage rates are at 5.5, 5.75. Is everyone doing more business considering that every single time rates head towards 6%, we see the demand get better? Imagine that for a year, right? Because we're working from the lowest, and I stress this all the time, we are working from the lowest levels of home sales ever, right? It's not like the early A. We have so many more people. We have over 162 million people working. We have 5 generations of buyers, cash buyers, investors. You put them all together. It doesn't take much to move the needle, but we've only seen the data get better when rates go from 6.64 to 6, and it just doesn't stay there. So labor data getting softer, Fed getting more rate cuts in, spreads getting better. This is why I try to highlight the spreads. If you look at the history of spreads, it should get better starting from 2024, and it did. All these things are beneficial for the future as long as price growth cools down, wages get to grow. If you fall into a recession, guess what? Home sales are going to go up, right? People go, oh my God, nobody's going to buy a house, right? Oh, millions of people unemployed. We did this in COVID. For all you guys that remember, 20 to 30 million people were unemployed. 5 million were in forbearance. Everyone said nobody's going to buy homes. And I go, yes, 7 to 8 weeks. We're going to get back. Why? We had 3% mortgage rates. 133 million people were still working back then. Doesn't take much to move the needle. So hopefully that doesn't happen anytime soon. We don't root for recessions. But outside of that, you need softer labor data. You need the Fed to cut rates. You need the spreads to get better. You only need half a basis point in rates to get down to that lower curve. So it's not much. And that gives you a little bit of sales growth. And we picked it up last year in our weekly pending home sales data and our total pending, where we saw a divergence in data, which was really weird for everyone because purchase application data last year had no year-over-year growth really until the late part of October. But our weekly data started to pick it up. That's another byproduct of having a tracker. These are homes that go into contract right away that will not hit the sales data until 30 to 60 days a little bit later. But again, fresh live data. Don't work with something very slow and old and wait for months. And by the time you wait for it, you're already missing out of what happens in the future.
That's very informative. Thank you, Logan. All right. Well, to stay on track with time, we are going to go ahead and progress. Before we take off today, just want to show you a couple things that the team's been working on the back end. So for all of you that are current Altos users, for people that have just gotten into the platform, a little bit of functionality to spotlight. What you're looking at here is our refreshed dashboard, and what's being shown on the screen is our favorites functionality. So when you're in the pro and the premium versions of the accounts, you can often have 40, 50, 60 reports. The favorites functionality exists so that you can easily identify the markets that you want to look at regularly, do exactly like Logan said, and check this weekly, inform your narrative, inform your clients, and at a glance view exactly what's happening in those areas. We take it a little bit further with our next functionality that we added, which is our weekly change indicator. So previously within the platform, you had to do a little bit of math, or you had to look at the chart lines to understand if you're growing or shrinking the numbers, exactly how they're changing. Now within the settings button, you can immediately show weekly change, which is an amazing feature that again allows you to contextualize what's happening in the markets that you care the most about. The final thing I want to talk about really fast is that our tiles that are in the dashboard, as well as our market snapshot functionality, exists so that you can modify the tiles to include the data points that you care about. You can edit all of the data fields that you'll find within your individual city market reports. You can modify them. And once you get them modified, you can view the snapshot and you can download and share the snapshot. It's an amazing social media asset. It's a great feature to include in your emails, whether they're sent through the Altos automated system or something that you're manually doing yourself. So again, I do want to encourage everybody that's not on the platform, take advantage of getting your free Altos account. For those that have the free account, reach out, schedule a demo, understand how we can help you share this data, learn about the data, talk about the data, be the market expert. That's what we're all about here at Altos, and we hope that you take that journey with us. Thank you to everyone that has joined today. Thank you to the one and only Logan Mohtashami for being here. Appreciate all of your time. The replay will be sent out, which is a common question. If you want to know what's happening in your market, schedule time with our team today. Don't wait. The market's moving. Don't let it move past you. Thanks for being here. Bye.